happened elsewhere in the broader capital goods arena. Durable goods especially were exceptionally strong in 2021, but a lot of those orders were not fulfilled in 2021, and those are expected to be delivered sometime, hopefully in the first or second quarter of 2022. Just as a little anecdote, there's a person building a house right next to the house that I live in here in Florida. And they started that house back in July of last year, and they were hoping to move in last month. Now the expectation is that he may not move in until the second half of 2022. And I can't tell, we could spend a whole hour just going through all the issues of just this one house, but it's a microcosm of what happened and what is still to happen. So the good news is that the tension in the freight market and the sheer volume of freight that is yet to be delivered, we're still expecting that a lot of that to not dissipate, not get canceled, but continue on through. So things like washing machines and cars and all kinds of durable goods that could not be delivered in 2021. The good news is that in spite of all that, we had a great freight market in 2021, and a lot of that freight is going to be delivered in 2022, which will be great for the entire industry, that we still have that sort of stronger for longer freight environment as we start the year here. So some of the things, if we just go back to the slide there, sorry. Gwen, if you want to just back up, yeah, thank you. So in terms of how this all, it's kind of more of everything is how we think of it, and that goes for not only we're going to have growth in freight, even though we had a terrific amount of growth in freight in 2021. We're still going to grow in terms of absolute tonnage, freight tonnage in 2022. It's clearly, just the law of large numbers is not going to allow us to grow that kind of freight at the same rate. But in terms of absolute tonnage, we still expect more freight to be moved in 2022 than 2021. But then on the flip side, in terms of where we're going to find that capacity to move that freight, that's probably near and dear to everybody's heart on this call. We expect a loosening up of the supply chain of trailers and tractors as well, and pretty much anything that moves freight. There'll be more of that capacity also coming into the market. So that's why we're calling it sort of the more of everything. Whereas in 2021, it was the scarcity of everything. We think that we're going to put that behind us, and it will be more of everything as we go forward. So that has implications, obviously, for freight rates. There'll be more capacity out there. There'll be more freight to move, but more capacity out there. So we think that we've probably seen the peak of the spot rate market. It'll fluctuate, obviously, from a season to season. But the extraordinary spot market, freight rate market that we've had in 2021, we think that we're probably past peak on that. But that doesn't necessarily mean that we're going to drop off a cliff. If anything, we'll just see a gradual moderation in the general freight rate environment as more and more capacity comes into the market. Some of it is, again, we've sort of got a few self-governing mechanisms in terms of not only manufacturing capacity at the OEM level for trucks and trailers, but also a horse that's been beaten quite thoroughly in terms of the supply of drivers. That we also expect to gradually improve that condition, but not so dramatically that all of a sudden we're going to see the supply-demand pendulum swing violently to the point where we could have a major overcapacity situation anytime soon. We do not see that. That's always a potential risk in this market, but given sort of these other natural barriers to that happening that are still not yet resolved, we don't expect a major drop off in freight rates or profitability for the industry, but certainly a gradual loosening of pretty much everything. In terms of potential risks, there's the Fed is the big gorilla in the room in terms of the overall economy. It's amazing how the thinking on what the Fed is going to do or what needs to do changes, almost by the minute, depending on who you speak to, depending on what you're watching on CNBC or Bloomberg or wherever you get your news from. So the current expectation is somewhere around, the Fed will start hiking in next month. And the question is, how fast and how much in 2022 are we going to have to fight in terms of a headwind of Fed funds rates increases and just generally a higher interest rate environment. You have to remember that, I don't know, I'm dating myself, but I remember the days of, double-digit interest rates. But we have a whole generation of people in this country now who know nothing but free money. So that's going to be the psychological challenge of getting through a different kind of interest rate environment than what we've had before. But in terms of how rapidly the Fed might raise rates, I've done some work. I've looked back at past, Fed tightening cycles, and it seems to be that, there's a pace that the economy can digest quite well without tipping us into a recession. It seems to me, though, that when we start talking about a collective rate raise of, say, 200 basis points in a calendar year, that's where we really get into, that's when the red flags start going up in terms of that's a little bit too much, too fast for the economy to digest. So we'll see what happens. I think our economists are sort of in the 125 basis point area right now at our BMO economists. And that I think is something that our economy can digest and handle and work through and adjust to without tipping us into a recession. But if things go much faster than 125 basis points, like I said, if we get up around that 200 basis point range for the year, I personally don't think that's going to happen. But if we do go that far that fast, it's like history says that that's probably the danger point where the Fed is likely to tip us into a recession. So we can go on to the next slide here. All right, great. So just, real quick on this, just to put some numbers around what I was just trying to express. In terms of just big buckets of truck freight, this is sort of how I think about it. I haven't actually seen, industry numbers that are, this neatly divided, but in terms of construction, consumer, and auto sales as sort of a proxy for the general manufacturing environment, this is how I like to look at things. If any one or two of these pillars of freight, as I call them, are not performing or functioning well, that's not good for the entire, trucking industry or quite frankly, the overall economy. So the fact that we're coming off a very strong year in all three of these segments, and yet, we've got expectations that, again, we're not going to match the growth numbers, but in terms of a continuation of the momentum in these three very big, truck freight segments, we've got, positive green arrows in each one of them to various degrees. I think just to, confirm this is in terms of a mid to low single digit, freight growth environment. I just looked a couple of minutes ago before we started the webinar. FTRs, if you're familiar with them, they're a forecasting outfit that follows the trucking industry. They're looking for truck loadings in the U.S. in 2022 to increase somewhere just shy of 4%. So you sort of mash all these together, and we come out to pretty much the same place. And that's why we're at this point we'll see what happens, how things develop overseas, and there are a lot of things that can come out of left field. But right now, this is how we're looking at it, and this is what we're expecting. Next slide, please. Okay, and this sort of dovetails into, you know, what Jared and Colin are going to be talking about in terms of sort of proving this out from a supply chain standpoint, and aluminum is obviously such a huge import to trailer manufacturing. I just thought I'd you know, give you a sense as to what the outlook is and how that might progress through the year in terms of the production of freight carrying capacity. On the left here, we've obviously got the tractor production, and both of these kind of tell the same story to slightly different degrees. Obviously, tractor production has really been held back more by microchip supply shortages that really, you know, don't really feed too much anyway into the trailer production supply chain. But that's probably explains some of the differences here. But at the end of the day, we're expecting a little bit of growth in the output from the OEMs. So a gradual improvement in the first half of the year, and then, you know, fingers crossed, really accelerating as things really become, you know, a lot more familiar and normalized in the global supply chain. Really seeing that accelerate quite significantly in the second half, both quarters, third and fourth quarter. So if we're thinking about, okay, used values, or you know, when are you going to start to see more inventories on you know, on your dealer you know, floors and so forth? This is kind of what we're hoping for and expecting, is that first half of the year is still a little sluggish. Not a whole lot of supply coming into your dealerships, but the picture looks a lot brighter for midsummer and into the fall. And with that, I think I'll hand it over to Colin, again, one of the real stars of the show, who'll bring us to the next level.
Yes, and may I just also remind everybody, if you do have a question, please use the chat function. It should be on the right-hand side of your screen. And after the conclusion of all three presenters, we'll go through the questions and try to answer as many as we have time for. I also like to suggest, if you would like to hear more from Mike Zim, he does publish a quarterly monitor that is free and available to anyone who is interested on our website. That's bmotf.com. So if you're interested, you can just sign up and receive more information each quarter. All right, Colin, thank you very much. It is officially your turn now. Thank you.
Thank you, Heather. Thank you. And welcome. Greetings from London, everyone. I hope you're having a good day. So I'm going to take some of the themes that Mike talks about there and put them in a global perspective. I'm here to give the global overview because, of course, aluminum, and I'm going to force myself to say aluminum and not aluminium, aluminum is a global market, 67 million tons of global production, over half of which is in China. In fact, of the commodities I cover, this is the one where China dominates supply more than any other. And that's important. It's important for global trade flows, global trends, and indeed global demand. And I'm going to talk through the demand situation as we see it, some of the key macro factors, and how that's impacting on the aluminum market. So the slide you can see there, we're just looking at global manufacturing. The stay-at-home trade has been fantastic for metals. And why has that been? Well, a couple of things. Governments have had to push fixed asset investment quite hard in order to bolster economic growth, and that generally is metals intensive demand. Second thing, everyone's been sitting at home looking at their fridges, looking at their kettles, going, I need to upgrade that. And you've seen a very strong durable cycle, one of the like that we haven't seen for a number of years. So in actual fact, global manufacturing has done pretty well. If we look at that global manufacturing PMI barometer, almost 90% of the countries we track are in expansion at the current time. Global industrial production has had its best year since 2010, but we are starting to see that slow. A couple of reasons. The fiscal impulse is waning, particularly in the Chinese market, and I'll talk about that in the next couple of slides. But also, we're running into these supply bottlenecks, and these supply bottlenecks are certainly delaying demand in a number of areas, pushing it further into 2022, and we are still looking there for a decent metal demand here, but one which is actually constrained in many instances by either the supply side of commodity markets or indeed the logistics involved in getting material to the end users. If you can push on to the next slide, please. Thanks, Gwen. In fact, the inflation slide. Sorry, that's the one. So this is the key thing. I mean, we're all feeling. I suppose people like myself in Europe are perhaps feeling it a little bit more than others, but we are starting to see inflation come through everywhere. The signs have been emerging for a few months now, but this is why, as Mike said, we're talking rate hikes. Pretty much every economy in the world, with the exception of China, is looking at hiking rates at the current time. And it's a question of almost how much the tightening is going to be over the coming year, because inflationary pressures are definitely feeding through. We're starting to see it in the producers that I track in the metals and mining industry. And of course, we're starting to see it hit the consumer level. Just one example there, the European gas price index. Actually, if I was to put it through today, it's up even more, of course, with the Russia-Ukraine tensions that we've seen. That is now starting to feed through to electricity prices, which is feeding through to the end consumer. And that may impinge their ability to spend. We can talk about that a little bit more in a minute, but clearly we're looking at a point now where consumers have had free money to a certain extent for a little while. They're now getting a little bit less free money, and they're now starting to feel pressures coming through, which will affect their purchasing patterns. The second element, though, is of course logistics. Now, you're all very well versed in the trailer markets, but one thing I've been looking at a lot over the past year has been container markets, because we've seen these global container indices really surge in terms of getting material. Now, a lot of this has to do with China's zero COVID policy. Anytime we see COVID cases at Chinese cities or port cities, they get locked down, and that means queues of vessels, and that means material doesn't move as fast as it would normally do. Now, as a world, we will sort this with time. We're great engineers. We're great at getting material to the right place. But for here and now, if you're a purchasing manager, and I'm sure many of you on this call are responsible for purchasing in one way or other, you're nervous because you've spent much of the last 12 months looking for material that's stuck in a port in China and maybe hasn't arrived, and you're scrambling. And in an inflationary environment, you're willing to pay a little bit more for that material to get it on hand. And this process continues. There's a natural scarring, if you want, of purchasing managers where they've had demand problems. They've had problems with getting material into their sites, and therefore they want to hold a little bit more. We are still in a restock mode in many cases. Now, the question is, when does that get pulled through? But what it is doing at the moment is certainly amplifying premiums in various markets. And what we've seen is record premiums over London Metal Exchange prices for delivery of prompt material in recent times. And there's a number of other reasons for that, which we do. Let's move on to the next slide, please. One of my key catchphrases is you get China right, you get metals markets right. And for aluminum, that is still the case as well. Now, this has been a market, in my career, this has been a market which has seen secular deflation. Unlike some of the other commodities I would look at, copper, for example, whereby new mines are lower grade, higher impurity, coming at the top end of the cost curve. In aluminum, we keep building bigger, better smelters, more energy efficient smelters. And in particular, that's been a China phenomenon. China's gone from 8% of global supply back in 2000 to 58% of global supply last year. And we've had that deflationary influence come through in terms of Chinese exports. Now, that's changing a little bit. What I put up on the left-hand side there is the Shanghai Futures Exchange price, which is the dark blue line, against the marginal cost of producing aluminum in China. And you can see they track pretty closely together. That Chinese cost structure is crucial. We've seen coal prices in China head higher. We've seen alumina prices in China head higher, partly on logistical constraints, partly on pollution-related constraints. And as a result, cost structures have moved up quite significantly overall. We're starting to see that ease. The government in China has put in some very aggressive policy to ease the energy shortages that they had around September, October last year. Coal prices have halved since the peak, but still we've reset that base at a higher level than it was before. And that does affect through the cycle pricing expected for aluminum markets. Now, I mentioned before, inflation's hitting the end consumer. What we've always seen over time is that when we do see that inflation come through, it does hurt demand. I just put up base metals generally there against a US CPI on the right-hand chart. And anytime we have seen a surge in CPI, typically, as we go into a tightening cycle, as Mike talked about before, you do tend to see. Now, will we see, and Mike is absolutely right, the BMO economics team is looking for 5 Fed hikes this year, 25 basis points per time. That shouldn't be enough to cripple the economy. It should be enough to avoid a recession, but keep things going. But obviously, there's a very fine balance there. Where I'm probably a little bit more worried about is emerging markets overall. We're seeing energy pricing up. We're seeing grains prices likely to go up given the Russia-Ukraine situation. And as a result of that, that's where I might see demand weakness coming through this year. I actually think in the developed world, there is a lot of pent-up demand still to come through. Let's go to the next slide, please. One key thing that has changed, in fact, there's two key things in this slide I'm going to talk about that have changed in the global aluminum market. The first thing is we've started to see, even with the prices where they're at today, I mean, north of $3,000 per ton on the LME for aluminum, you've seen smelter closures, most particularly in Europe, where, as I mentioned before, power prices have been surging. We've seen about 600,000 tons of capacity in Europe taken offline year to date. There is clearly a risk that more may go. And as a result, Europe's net trade position has moved almost to importing another 1 million tons more than we saw last year. Europe's going to be a net importer of primary aluminium to the tune of 5 million tons this year versus 4 last year. North America, also a net importer. Japan, also a net importer. And new addition here, China is a net importer of primary aluminum. Now, this is a big shift. Initially, it was opportunistic in the 2020 downturn, whereby no one else wanted material, so China imported it. Now what you're seeing is under the decarbonization agenda in that Chinese economy, you are seeing a push to offshore primary carbon-intensive hot-end capacity and import the product. We'll still see China as a net exporter of semi-finished products, but we do expect to see them a net importer of primary aluminum. And with that, we now have a lot of competitive tension in that primary aluminum market, particularly actually for value-added products. And that is really reshaping the industry. Let's move on again, please. Now, aluminum is not a market where we're short of inventory. There's actually, 10 to 12 million tons available, depending on various, out there, depending on various estimates. The challenge is how much of that is actually available to the market. This is a thesis in itself, but the London Metal Exchange system is to a certain extent broken. It promotes concentration of material in various sites. So what we see is a lot of aluminum inventory is in Port Klang in Malaysia. And actually, as a marginal buyer in the market, you can't get your hands on a lot of that material because it's stuck in a queue waiting to get out. The LME has not fully sorted the large door in, small door out system that it's had for a number of years. So actually, the available inventory of the market is very tight at the current time, which is reflected in the prices that we're seeing today. And with the smelter capacity idling in Europe, we are seeing a record deficit in the primary aluminum market this year. We're looking for about 1.9 million tons. So that will run down that available inventory further. In future years, we are expecting a bit of a Chinese supply response. China has a cap in primary aluminum capacity of 45.4 million tons. We expect it to be working towards that, but that still leaves kind of 5-6 million tons of leeway. Now, if that does not happen, we're looking at a more prolonged deficit. You can see there, we're looking at 2023 back towards balance, partly because we are a little more cautious on global demand as we hit inflation. But for 2022, there really is a tightness out there. It is a bona fide deficit, and it is one where we'll see a fair rundown of inventory. Just one last slide from me to talk about a couple of the changing dynamics. The first one looks at, on the left-hand side there, looks at annual aluminum consumption growth over time. The dark blue bars are China. This has been a China-dominated market. Now, even in 2020, we saw Chinese demand growth. Well, now, if we look on a go-forward basis, that is changing. We're seeing a lot of reshoring of capacity away from Chinese manufacturing, a lot to do with geopolitics, a lot to do with critical value chains. But with that, we're starting to see the growth come from outside of China for the first time in 20 years. The second factor I wanted to flag is carbon. As a commodities analyst, I'm not going to price in carbon yet into my aluminum price outlook over the coming 5 years, but I am starting to think about it in terms of the long term. And of all the commodities I cover, aluminum is the most impacted in terms of the top end of the cost curve by potential carbon pricing. If I run a $60 per ton carbon price through global aluminum smelting capacity, the top end of that cost curve, and therefore through the cycle clearing price, goes up by over 40%, mainly due to the coal consuming capacity at the top end of the cost curve in China. So with that, what that would mean is a steepening of the cost curve over time. Great for producers like Norsk Hydro, which I'm sure you'll hear in a minute, because they have very low carbon electricity, but it is going to see a shift over time. Do I see a green premium in these markets? Perhaps, but only as a stepping stone. I see more embodied carbon as a specification, a qualification process that might change over time. So with that, I mean, that's my view of the global markets. We are looking at a record deficit for this year in the primary aluminum side, and it is a big change from a market which has seen this deflationary trend over a long period of time. I'm now going to pass to Jared to talk through Norsk Hydro's view of the extrusions market. Thank you.
All righty. Thank you, Colin. I assume everyone can hear me okay? Yep, very good. Thanks in advance here a bit for having me. It's a pleasure to speak with all you guys. I wish we could do this face-to-face, maybe next time. It's an honor to have a few minutes to spend with you guys, and hopefully I can give a little bit more background and information around, the capacity issues the extrusion industry is facing and labor, and really piggyback off of the things that Mike and Colin have said. Real quick here about me on the commercial trans, just so some of you on this call know who I am, and I know some of you, but the commercial transportation segment is the trailer segment for Hydro North America, and so I know the market very well. I've been doing it for a long time, and it's our largest single market vertical market we serve here in North America. So the trailer market consumes about 22% of our annual volume. So, the point here is it's big for us, it's important for us, and we're really doing everything we can to get more extrusions out into the OEs so they can get you guys more trailers. You can carry on there, Gwen. Yeah, so what I'm going to cover today is I'm going to just touch on a little bit about Hydro. I'm going to talk about labor and kind of what happened to us last year and where we're at with labor and how it's impacting capacity. I'm going to talk about aluminum pricing. Again, give a little bit of historical context, share with you guys what makes up the pricing, so you get a better idea about that. And then finally, the big topic is capacity. So, hopefully I can tell a bit of a story around capacity, kind of where we were, where we are, and where it's headed, and what we see as the future on capacity, and when things might get better short term, and then even long term, what's happening. So first, a little bit about Hydro. As noted there on the slide, we're really large company, about 20 billion plus in sales annually. A renewable energy aluminum company. We're fully integrated. So Hydro has assets in mining and bauxite. We have assets in smelting. A lot of assets in recycling or billet cast houses, and of course, now downstream, as we call it, with aluminum extrusions. Again, large company, over 30,000 employees globally, and Colin touched a little bit on the sustainability and the CO2 emission issues. I just recently, added that to my responsibilities around our North American initiatives. And that is going to be a big topic and conversation going forward. Next slide, please. Yeah, so here's just a larger map of where Hydro is positioned with some of these assets I mentioned. Again, our bauxite and alumina is that mining is in Brazil. The smelting is in several different countries. Same with our recycling and billet cast house, and of course extrusions. And we are the world's largest extrusion company. A large amount of assets there in North America and Europe, of course. But yeah, so we're the largest extrusion company. We also have the largest share for the trailer market. So we're continuing to grow and invest in our extrusion assets, and I'll talk a little bit more about that and how that's going to impact you guys going forward. Next slide. Yeah, so drilling down a little bit here in North America, Hydro here in North America has about 5,600 employees. We've got 22 manufacturing sites. Of those sites, 16 of them or so are extrusion facilities. The other are cast house. We do about $3 billion in sales here. We have the largest share in the market and a large amount of customers across all the major markets here that are consuming extrusions. Next slide, please. Yeah, here's another visual map of where our assets are here in North America. You can see the extrusion facilities and some of the other assets we have here. Pretty much all these plants service the trailer market, some more than others. But geographically, we have North America and the U.S. covered very well. And we obviously typically try to manufacture as much of the extrusions we can to the OEs, as close as we can to the OEs. Yeah, and again, I'll touch on this in a minute. We continue to invest very heavily here on the extrusion side to try to increase capacity, both short-term and long-term. Go ahead. Yeah, just one little final thing here. We don't just supply the lineals to the market. Again, in particular to the trailer market, Hydro provides kitting for certain parts. We provide engineering and design assistance. We do a lot of fabrication for the industry. We do finishing, so we have paint and anodizing. That's not so much used in the trailer market. Other markets have that. But yeah, we do a lot more than just providing lineal extrusions to the industry. So, okay, moving on here. Next slide, please. Yeah, so first of all, just to talk a little bit about labor. As we've all been hearing and talking about the Great Resignation, of course, this has been a big impact for Hydro, globally, and of course here in North America, and it's had a big impact on our capacity challenges. So last year, the labor situation not only impacted our ability to extrude more in our plants here, but it really also hit the billet supply. So last year, there was a huge challenge not only on the labor here, as I just said, but also we had metal challenges, even Hydro. So we had a lot of problems getting billet coming back into this country. Early on post-recovery, it was more of a financial advantage for some of the global billet to go into Europe. So it took a while for the premiums and the fees to come back to make that billet more attractive to come here in North America. But the long and the short of it, labor was impacting that as well. It impacted domestic billet manufacturers. So it was a big problem along with labor. As we've gone into this year and we ended last year, the metal piece has worked itself out. We don't anticipate having problems this year getting our hands on billet. But we are still challenged with the labor situation. It has gotten better of late, but in particular in how it impacts, you guys in this industry. We still have a couple large plants. In fact, our largest plant in Cressona, Pennsylvania, is still struggling with labor. And short term, they are our biggest plant that can help us get out of it. They have the most capacity yet to be gained by labor. So, it is getting better. We are getting people coming back. We're getting retention, people staying. But the problem with this is we have such a big backlog. We still have all of our major customers are on allocation. So while, Mike talked about being pretty bullish on the back half of the year, Mike, I don't want to rain on your parade, and I don't want to be Debbie Downer here, but we're still a little spooked right now. We do believe it'll get better in the second half of the year, but we have a lot of work to do to get there, to gain confidence that we're going to be able to produce a lot more in the back half of this year. Next slide, please. Yeah, so now getting into a little bit more detail on the aluminum pricing. So your extrusion pricing is really made up of 3 different categories. There's the LME, the Midwest transactional price, the Midwest premium, and conversion. And I broke out the billet premium because the billet premium is part of the conversion cost, right? So, the conversion cost is, the billet premium, it's our packaging cost, our labor, the margin, and all that. So that's the conversion added onto the LME and the Midwest transactional price. But when you break these components down, it really shows what's happening here and what's gone on really more recently around pricing and how fast it's exploded. So as you can see there from the LME, vertical chart going the wrong way, if you will, here. It wasn't that long ago that the LME was around 90 cents a pound. And if you go back a little bit further, some of you that have been around a while remember when this used to typically trade in the 70 cents a pound range. So just unprecedented highs, nearly breaking the all-time record that was set in 2008. But we're at 13-year highs right now around the LME. On the Midwest transactional price, again, you can see not that long ago, it was around 15 cents a pound. And historically, this has been around 8 to 10 cents a pound. This morning, it's at 37 cents a pound. So again, for perspective, you can just see a tremendous amount of increase in cost on the Midwest premium. And then also, as I touched on a minute ago about the billet premiums, just like the LME and the Midwest transactional prices there, you can see not that long ago, it was under 15 cents a pound. Again, historically, billet premiums have been 8, 9, 10 cents a pound. And here we are, right now, if you were to go out and try to buy spot billet, you're looking at over 30 cent a pound premium. So, it's unfortunate, and I'm sure you guys are all seeing this, but a lot of the increases you're seeing is coming from these 3 big things. And of course, we're having to pass this on through. Now, many of you want me to try to forecast what's going to happen, and I'm not going to do that. But I just, for a little bit of context, I can't touch that for various reasons, but even the experts, and even Colin may blush a little bit when you ask him to forecast it. For context, we have a aluminum expert that does quarterly calls with our customers. In December, just this last December, his forecast for the average of 2022 for the LME was going to be $1.15 a pound. And the Midwest premium would settle in around 23 cents a pound. So he forecasted this in December. Today, this morning, the numbers were $1.50 a pound for the LME. And as I just alluded to, the Midwest transactional price is trading at 37 cents a pound. So obviously, there's a lot going on with the geopolitical issues. Colin touched on the deficit, strong demand. So in terms of what's going to happen going forward, everybody's guess is as good as ours right now. And I think even the experts would have a hard time predicting what's going to happen here. Moving on, please. These are just some definitions of those 3. We can skim over that. Yeah, so moving into the capacity situation here. So what you have here is the North American total consuming extrusion pound market in billions of pounds. And again, a little bit of a backdrop that what's happened and what's kind of set up the stage here at a macro level. So if you look back there to 2009 when we had the Great Recession, you can see a tremendous drop in consumption. And of course, that drove a lot of issues around demand, right? So basically what happened here is we had the Great Recession hit. Many extruders, had to hunker down then. We closed plants like everybody else. We had no idea what was going to happen. Investments got pulled in. And so you really had this pull-in of everything and the closure of plants. So capacity was taken out, and investments in new capacity either stopped or was stalled significantly. And then as we came out of the recession, things started to improve. And if you look at the macro numbers, it improved relatively quickly, but also it was taking some time to get back to where we were. So as we went through, 2010, 2011, up through 2014, the market was able to continue to absorb, the demand as it started to come back. But what also started to happen over that time frame is some of the bigger mega trends started to take hold. And some of that is automotive. Aluminum content in automotive has exploded. The EV market started to really take off and explode. And as you guys all know, the EV market, they have a lot of demand for aluminum and aluminum extrusions. Then you also had the sustainability, the green initiatives started to take hold. So you had some really three big mega trends starting to gain footing here as we were coming out of the Great Recession. And that was really setting up the stage for a lot of demand. Remember the backdrop of capacity being taken out and investments being stalled. So now as we get closer to as we get into the growth into 2018 and come closer to the COVID years, some investments and capacity started to come back online. Well, then as we all know, COVID hit. And of course that had a similar impact on the industry as the Great Recession. Not as bad, but it did cause some more closures of plants. People didn't know what was going to happen. And then some stalled, investments, but also some of the investments that had started were pushed back because of course, everybody, travel and the mitigation issues shut things down. And then we got into component shortages and all that. So really the bottom line here, if you go back 12 years, there's a lot of mega trend things and issues that happen that really has hampered the ability for the extrusion industry to increase capacity. Okay, so now what does it look like going forward? The next slide, Glenn. So this is a map of the investments in extrusion presses that we're currently aware of that's coming into play here over the next couple years. And you can see a tremendous amount of investments coming, a lot of pounds. And keep in mind, this does not include Hydro's investments. Hydro is investing very heavily. We have four to five large investments coming on stream as well. But to give you a little bit of context, the investments that are shown here, will have the capacity to generate about 500 million more pounds. And the capacity that we're putting in is probably another additional 250 million plus pounds. So nearly 1 billion pounds of capacity is going to be coming in line here over the next 3, 4, 5 years. But what that shows you is the demand, what's happening. And on the prior slide, you could see, our forecast going out further, we have, record demand coming into play here for North America. So the point here is these investments that are happening, they're just there to absorb the demand that's coming. So there's going to need to be a lot more investments on extrusion presses over the years to accommodate what we think is upcoming demand. And one final note here, on these investments that I show here, a lot of these are smaller presses. They're being put in to support primarily automotive and some of the building and construction markets who are also expecting a tremendous amount of demand coming on. Hydro is putting a lot of money into large presses. The large presses are what the trailer manufacturers need. So, we, as I said earlier on, we're the #1 supplier to the market. It's a huge, big, important market for us. And Hydro is investing very heavily in large presses across North America to prepare for the growth in general, but also to support the trailer market as we go forward. So, really in conclusion, on the capacity side, we've got to get through this year. Hydro does have some capacity coming on. We're a little, still a little, I say punch drunk a bit about how much it's going to improve in the back half. We are optimistic it will improve some. We also want to be very cautious here. We have a lot of work to do to catch up, and hopefully it will get better. But yeah, we're just going to have to see here. So that's it from me, Gwen. And we'll turn it back over to Heather or you, Gwen.
Great. Appreciate it, Jared. And I want to be respectful of everybody's time. Really appreciate all of the speakers. I definitely want to get to the first question that is showing here up in our chat screen, which is, will this presentation be recorded and available after the meeting? Short answer I will provide is yes. Gwen, do you have any other suggestions on how to share this material?
I can do one of two things. I can post it under our member section of our website. And if you have a login for that, you'd be able to access that, or I can email it to you directly. And then I can also send you the slide deck. So whatever anyone prefers for that. If you don't have a login for the website, go ahead and email me and I can make sure that I get that to you as well.
I think I do hear a few folks dropping off. I think Jared, Mike, Colin, fantastic job. A lot of good information, stuff that I don't even think I've thought through and I've seen the material. So really appreciate your insight. Very, very helpful. What I would invite is if you do have follow-up questions, I have a couple here, send them to Gwen if you don't mind, and we'll make sure that our speakers can follow up and perhaps provide an answer or some sort of reference to your question. All right. Thank you very much. Everybody have a great day.
Thank you.